The fiscal years of 2024 and 2025 represented a structural shift for New Gold Inc., NGD.TO. Long characterized by its heavy capital reinvestment cycle and the associated operational risks of transitioning two major mine sites, the company reached a long-awaited inflection point in mid-2025. This analysis explores the convergence of operational de-risking, aggressive debt retirement, and a historic commodity price environment that ultimately catalyzed the $7 billion acquisition of the company by Coeur Mining. By examining the granular technical progress at the Rainy River and New Afton mines, the strategic implications of the K-Zone exploration success, and the financial mechanics of the merger, this report provides an exhaustive evaluation of New Gold's investment case. New Gold's trajectory over the past decade has been a study in capital discipline and geotechnical execution. The company's primary challenge was the simultaneous management of a high-cost open-pit operation at Rainy River and a complex block caving operation at New Afton. By the third quarter of 2024, the narrative began to shift as several growth projects reached commercial production ahead of schedule. The successful commissioning of the C-Zone at New Afton and the commencement of ore extraction from the underground main zone at Rainy River marked the transition from a builder phase to a producer phase.
This transition was perfectly timed with a macro environment characterized by gold prices exceeding $4,000 per ounce and copper prices reaching record highs on the London Metal Exchange. The operational maturity of the assets allowed New Gold to capture this upside, translating higher realized prices into record-breaking free cash flow and a massive deleveraging of the balance sheet. Rainy River, navigating the transition to higher-grade underground production. The Rainy River mine in Ontario has historically been the more challenging of New Gold's two assets due to its high-volume, low-grade nature and the capital-intensive requirement for waste stripping in the open pit. However, 2025 saw a transformation of the mine's economic profile as the operation shifted its focus toward high-grade underground feed. Operational milestones and grade optimization. In the third quarter of 2025, Rainy River delivered its strongest performance to date, producing 100,301 ounces of gold compared to 66,275 ounces in the third quarter of 2024. This significant increase was driven by the processing of higher-grade material from both the open pit and the underground zones. The first development ore from the underground main zone was mined in October 2024, ahead of schedule, setting the stage for a ramp-up to a steady-state production rate of approximately 5,500 tons per day by 2027. The strategic importance of the underground main zone cannot be overstated. It contains the bulk of the mine's underground reserves and serves as the primary supplement to the mill feed as the open pit reaches its final phases. The transition has allowed the company to maintain a stable throughput of approximately 25,000 tons per day while simultaneously increasing the head grade.
Life of mine extension and Phase 5 strategy. The 2025 operational outlook introduced a significant expansion of the Rainy River mine plan through the inclusion of the Phase 5 open pit pushback. This expansion extends the open pit mining life to 2028 and defers the processing of low-grade stockpiles until the end of the decade. By doing so, New Gold has maximized the present value of the asset, ensuring the mill is fed with high-grade ore during a period of peak gold prices. The exploration potential at Rainy River also reached a new level of interest in 2025. Following the first major drilling campaign since 2017, the company reported a 76% increase in gold mineral resources. This expansion was driven by a larger open-pit resource shell and the identification of new underground targets, such as the NW trend, which could potentially extend the mine life beyond the current 2033 target. New Afton. Technological advancements in block caving and copper exposure. The New Afton Mine in British Columbia remains a unique asset in the North American landscape, being the only operating block cave mine in Canada. Block caving is a low-cost, high-volume underground mining method that is particularly effective for massive, lower-grade deposits. New Afton's value proposition is further enhanced by its significant copper production, which provides a natural hedge against gold price volatility and allows the mine to report extremely low and often negative all-in sustaining costs (AISC) after byproduct credits. The C-Zone ramp-up and materials handling automation. The primary focus at New Afton during 2024 and 2025 was the development and ramp-up of the C-Zone, the mine's fourth block cave. In October 2024, the company announced that the C-Zone had achieved commercial production ahead of schedule. This was defined by the cave footprint reaching the targeted hydraulic radius, a technical milestone where the cave becomes self-propagating, and the commissioning of the automated materials handling system.
This handling system, which includes a gyratory crusher and a high-capacity conveyor system, has fundamentally altered the mine's cost structure. By eliminating the need for expensive truck haulage from the deeper C-Zone to the surface, the company has lowered its unit operating costs and reduced its carbon emissions. By mid-2025, the C-Zone was ramping up toward its full capacity, which is expected to facilitate a return to processing rates of 14,500 tons per day by 2026. Copper-gold production and revenue drivers. In the third quarter of 2025, New Afton produced 16,843 ounces of gold and 12.3 million pounds of copper. While gold production was slightly lower than the prior year period due to lower grades as the B3 cave neared exhaustion, copper production remained robust. The C-Zone is expected to significantly increase the mine's output over its life, with average annual production projected at 90,000 ounces of gold and 70 million pounds of copper, a 60% increase over the pre-C-Zone baseline. The economic impact of copper production is illustrated by New Afton's AISC. For the second quarter of 2025, the mine reported an AISC of negative $537 per gold ounce sold, as the high realized price of copper, $4.34 per pound, more than covered the operating costs of the entire mine. This makes New Afton one of the highest margin assets in the global gold mining industry. The K-Zone exploration and regional upside potential. While the C-Zone provides the medium-term production profile for New Afton, the discovery and definition of the K-Zone in 2024 and 2025 represent the mine's long-term future. The K-Zone is located in the eastern sector of the mine, approximately 200 meters from existing infrastructure. 2025 drilling results and mineralization grades. Exploration efforts at the K-Zone were at an all-time high in 2025, with 6 underground rigs actively targeting the core of the zone. The results published in September 2025 were exceptional, highlighting high-grade copper-gold porphyry mineralization. Notable intercepts included hole EA25312, which returned 142 meters grading 1.65% copper and 1.82 GT gold, 2.81% copper equivalent. Another significant result was hole EA25325, which intersected 98 meters grading 2.1% copper and 2.45 GT gold, 3.68% copper equivalent, including a 32-meter interval of 4.12% copper and 5.10 GT gold. These grades are significantly higher than the current reserves in the C-Zone, which average 0.72% copper and 0.65 grams per ton gold. The K-Zone mineralization remains open at depth and to the west, suggesting that the resource could grow substantially. New Gold is expected to release a maiden mineral resource estimate for the K-Zone in early 2026. Strategic infrastructure utilization. The proximity of the K-Zone to the existing C-Zone infrastructure allows for a highly capital-efficient development plan. The company has already initiated studies to evaluate utilizing the C-Zone crusher and conveyor systems for P-Zone ore. This brownfield expansion strategy is a key component of the investment thesis, as it offers the potential to extend the mine life beyond 2031 with minimal incremental capital expenditure. Strategic merger analysis. The Coeur Mining New Gold consolidation. On November 3, 2025, Coeur Mining and New Gold announced a definitive agreement for an all-stock merger valued at approximately $7 billion. The transaction is the largest in the gold sector for 2025 and creates a preeminent North American-focused senior precious metals producer. Merger terms and equity structure. Under the terms of the arrangement agreement, New Gold shareholders will receive 0.4959 shares of Coeur common stock for each share of New Gold. This implied a valuation of $8.51 per New Gold share at the time of the announcement, representing a 16% premium over the market price. Upon completion, existing New Gold shareholders will own approximately 38% of the combined company, ensuring they retain significant exposure to the future upside of the Rainy River and New Afton assets. Strategic rationale and synergies. The combination is driven by the industry-wide push for jurisdictional safety and scale. By merging, the two companies create a portfolio of 7 operating mines located exclusively in the United States, Canada, and Mexico. Approximately 80% of the pro forma company's revenue is expected to be generated from the US and Canada, significantly de-risking the business relative to peers with exposure to more volatile mining jurisdictions.
Financially, the pro forma company is projected to be a cash flow powerhouse with expected 2026 EBITDA of $3 billion and free cash flow of $2 billion. The merger is expected to be accretive to Coeur's net asset value, operating cash flow, and free cash flow per share. Furthermore, the combined entity will have the scale necessary to attract interest from larger generalist investors and qualify for inclusion in major stock indexes, which could lead to a significant valuation re-rate. Operational synergies and management integration. The merger brings together Coeur's expertise in underground mining and large-scale silver-gold operations with New Gold's proficiency in block caving. Management integration is a critical aspect of the deal, with New Gold's president and CEO, Patrick Godin, joining the Coeur board of directors. The combined company will maintain offices in Chicago, Toronto, and Vancouver, preserving the operational and corporate knowledge base of both organizations. Financial performance and capital structure optimization. New Gold's financial performance in 2025 was the strongest in the company's history. The combination of increased production, lower unit costs, and high realized metal prices led to a massive generation of cash from operations. Revenue growth and profitability metrics. In the third quarter of 2025, New Gold reported revenue of $486 million, up from $234 million in the third quarter of 2024. This growth was fueled by a record realized gold price of $3,458 per ounce and a realized copper price of $4.47 per pound. Net earnings for the quarter reached $142.3 million, or 0.18 cents per share, a significant increase from the $37.9 million reported a year earlier. The company's ability to generate free cash flow was particularly impressive. In Q3 2025, New Gold generated $213 million in free cash flow, representing a massive jump from the $42 million generated in Q3 2024. This free cash flow generation allowed the company to accelerate its corporate objectives, specifically its debt reduction program.
Debt reduction and liquidity positioning. New Gold utilized its record cash flows to aggressively deleverage its balance sheet. During the third quarter of 2025, the company repaid a total of $260 million in debt obligations. This included the full $150 million that had been drawn on its credit facility to fund the new Afton ownership increase in early 2024, as well as the redemption of the remaining $111 million of 2027 senior notes. The company exited the third quarter of 2025 with $123 million in cash and cash equivalents and a fully undrawn credit facility. This fortress balance sheet was a major factor in the Coeur merger, as it positioned the combined company to have a net cash position and the financial flexibility to fund high-return organic growth projects. Macroeconomic drivers: gold and copper price trajectories for 2026 and 2027. The investment analysis of New Gold is heavily influenced by the bullish outlook for its primary commodities. Gold and copper are currently benefiting from a unique combination of geopolitical, fiscal, and structural factors. Gold, the quest for $5,000 and beyond. Gold prices soared in 2025, driven by central bank demand, geopolitical instability, and concerns over U.S. fiscal deficits. Major financial institutions have revised their forecasts sharply higher. J.P. Morgan projects gold prices to average $5,055 per ounce by the fourth quarter of 2026 and push toward $5,400 per ounce in 2027. Goldman Sachs and Bank of America have issued similar forecasts, citing the debasement of fiat currencies and structural central bank buying as permanent drivers of the gold market. For New Gold and the pro forma Coeur New Gold entity, these prices represent a transformative scenario. With a consolidated AISC guidance of approximately $1,025 to $1,125 per ounce for 2025, the potential for margin expansion is unprecedented. Every $100 increase in the gold price translates to a significant boost in free cash flow, providing the capital necessary to accelerate exploration and shareholder returns.
Electrification and supply constraints. The outlook for copper is equally compelling. The global transition to clean energy, the expansion of the electrical grid, and the massive power requirements of AI data centers are driving a structural deficit in the copper market. Goldman Sachs expects copper demand to overtake supply by 2029, with prices projected to average $10,710 in 2026 before trending toward $15,000 per metric ton over the longer term. New Afton's copper production is a high-value asset in this context.
As a primary North American producer, the mine is well positioned to benefit from regional supply chain security initiatives and potential tariffs on imported copper. The critical mineral status of copper in Canada further ensures that the operation will receive government support for infrastructure and permitting. Technical risk assessment and operational challenges. Despite the strong performance in 2025, New Gold faces several risks that must be managed to ensure the success of the pro forma company. Mine life and reserve replacement. One of the most persistent concerns among analysts is the relatively short mine life of the current reserves at both Rainy River and New Afton. While the C-Zone and Phase 5 pushback have extended the horizon to 2031-2033, the company must continue to successfully convert resources into reserves. The K-Zone at New Afton and the recent drilling success at Rainy River are critical to addressing this risk, but they require ongoing capital investment and technical de-risking. Inflationary pressures and labor costs. Like all mining companies, New Gold is exposed to inflationary pressures in energy, consumables, and labor. In late 2025, the company noted that cash costs at Rainy River were trending at the high end of guidance due to higher underground mining costs and camp costs associated with an amended underground contract. The pro forma company will need to utilize its increased scale to optimize its supply chain and mitigate these cost increases.
Geotechnical and block caving risks. Block caving is an inherently complex mining method. While the C-Zone has reached hydraulic radius and is self-caving, any changes in the rock mass behavior or ore fragmentation could impact production rates. At Rainy River, the transition to underground main involves managing geotechnical stability in the crown pillar area between the open pit and the underground workings. New Gold's management has demonstrated a strong track record of managing these risks to date, but they remain a constant operational factor. Conclusion: the investment case for the pro forma entity. The investment analysis of New Gold, NGD.TO, concludes that the company has successfully completed its transformation from a capital-consuming development story to a high-margin, free cash flow engine. The operational maturity of Rainy River and New Afton, combined with the spectacular exploration success at the K-Zone, provided the foundation for a value-unlocking merger with Coeur Mining. For existing New Gold shareholders, the merger represents a strategic victory. They receive a 16% immediate premium while retaining 38% ownership in a much larger, more diversified senior producer that is better equipped to handle inflationary pressures and geotechnical risks. The combined entity will be one of the top 10 precious metals companies in North America, with a market capitalization of $20 billion and a cash flow profile that rivals the world's largest miners. As gold and copper prices continue their structural upward trajectory, the pro forma company is uniquely positioned to capture outsized returns for its investors. The concentration of assets in Tier 1 jurisdictions, Canada, the United States, and Mexico, provides a level of risk mitigation that is increasingly rare in the mining sector. With a clean balance sheet, a net cash position, and a fully funded organic growth pipeline, the Coeur New Gold merger creates a vehicle for investors seeking exposure to the 2025-2027 commodity cycle. The successful integration of these assets over the next 12 to 24 months will be the final step in validating what has been a remarkable turnaround for the New Gold portfolio.